Let's get right to the floor show. Joining me now to talk about that and all the cross currents here, Goldman Sachs Tactical Asset Allocation Head for the Investment Strategy Group, Brett Nelson. Brett, for a minute there, more than a minute, econo data took kind of a backseat to everything else, all the exciting headlines out there. But today, you look at the producer price index number that came out for January across the board, whether it was headline or core, all the numbers came in hotter than expected. So what do you think is really at work here with the market sell-off?
Well, I think as you generally see in the markets, usually it's a confluence of factors that come together as opposed to any one thing. So it's interesting. On the PPI, we've seen a lot of volatility in the inflation numbers. But if you look at the overall trend, especially given that shelter we know is coming down, shelter inflation, because we see what rents are today, and shelter inflation follows 12 months after. And so that offset between some of the residual tariff effects and shelter coming down, we think will continue to let inflation come down on a glide path. And you'll note today that interest rates are down, inflation break-evens are pretty steady, and so it's not really an inflationary concern. But some of the things which are obviously worrying, as you pointed out, obviously we had some announcements in terms of AI disruption and headcount, so that's got people focused on the labor market. And in addition to that, you have all of the uncertainty around BDCs, with Apollo taking a write-down on one of their BDCs last night. We had one of the companies in the UK.
Explain to our viewers what a BDC is, for those who don't know.
So this is basically a version of private credit where you have a bunch of these middle market loans that have been made to private companies, which are then packaged into these various funds. And that allows people to harvest the interest that is collected on those loans.
Is it a case where investors are beginning to get very nervous about credit lending standards? And that's why everyone in that space, whether it's Carlyle or KKR or Blackstone, or, as you see, Apollo, Owl started it with private credit. And, those concerns are hitting Owl once again today. Is it that paired with the worry that unemployment may start to tick up? You just saw 4,000 employees at Block done, year out, due to AI.
Yes, it's interesting. We dedicated an entire piece in our Outlook to this idea of private credit. And one of the questions we got a lot from our high net worth clients was, is this the next subprime? But if you actually look at the private credit exposure of US banks, it's only 1% of their overall loan exposure. And so this is very different than the exposures that we had in the subprime crisis, when subprime mortgages were a large share of the bank's balance sheet. And for an individual consumer, usually your mortgage represents about 70% of your overall debt stack. So that's very different than what we're seeing with these private credit exposures. And then in addition to that, when we look at the loss scenarios with these, the Fed in their annual exposure actually runs in their stress test what happens if all of these loans go bad, and is a very marginal impact on the bank's liquidity and overall capital levels. So again, when we're looking at the exposure and the risk that this transmits systemic risk through the banking system, we just don't think that that's a likely scenario.
Okay, if not the private equity guys, what are you advising when you talk about tactical investing?
Yeah, so our general theme is that we want to stay invested in the U.S. and overweight U.S. assets. We've had a long-standing theme for the past 16 years of telling clients to overweight U.S. assets and have an investment theme of U.S. preeminence. And our idea with U.S. preeminence is that the U.S. is the largest economy in the world, it's the wealthiest economy in the world, and it has the largest and deepest financial markets. So that translates into more investment in innovation, healthcare, defense, et cetera, and that means stronger economic growth and earnings growth. And our forecast this year for the S&P 500 is driven by earnings growth, and that's the reason why we continue to see the S&P outperforming other developed markets where we think the earnings growth will be less.
Brett, thank you. A rock and roll day, and certainly with this final hour of trade, we're watching all of the movement. Thanks for coming on.
Thanks for having me.